Okay. Hello, everybody. Welcome to Money Matters on Monday with Hung Lu, me. Okay. So we're going to get started. It is, let's see here, September the 16th. So we are at the start of the school year. So hopefully everybody got off to a good start with the school year with their children. All right. So today we are going to do, I think this calculation is going to be pretty small. So this session today should be a little bit shorter. I got asked to talk about how to calculate net worth. So we're going to run through a quick calculation on that. And I'm also just going to talk about how to use it if you aren't using your net worth to its full capacity here. So, of course, before I get going, though, I do have to throw out a disclaimer there. Okay. This is for educational purposes only. So please check with your financial advisor, especially to calculate your net worth, and your accountant as well. Okay. And anybody else who you trust to, just go through some of the data here. All right. So, oh, yeah. So this Friday is our monthly mastermind. So every single month we get together, like minded individuals focusing around real estate, and we talk about a different strategy in real estate and talking about some of our challenges and supporting each other through it. So this month, we actually have a very special guest coming on who's actually going to be working through some of the common fears that as real estate investors, whether we're starting new or experienced already, doesn't really matter. Some of the fears that we go through when we're in real estate. So one of them is FOMO, like the fear of missing out. Even in today's crazy economic interest rate situation, there are people taking action in acquiring businesses maybe when they really shouldn't be because the numbers don't work out, but they have that fear of missing out. And so they're acquiring these properties that may not make 100% good sense. And then another fear is I don't know how to analyze. I don't have all the data. It's not perfect. It's not the right deal. And then they don't take any action. And they're analyzing and analyzing and analyzing and, going on to like 6 months or 3 years of analyzing, and they still have not been able to pull the trigger. Okay. So those are like two of the common fears I would say that real estate investors face. See, another one would be I don't want to take on debt. Debt is a bad thing. I'm going to be, like having a third mortgage or a fifth mortgage or, the 100th mortgage. That's a bad thing. Usually by the time you get to your 100 or by the time you get to your like 10th mortgage, you're okay with debt. But it's getting to that path of getting so many mortgages or so many loans that people struggle with the idea that there could be good debt out there and that good debt is something that we're okay with taking on. Okay, so that's this Friday. We're actually bringing in a special guest to walk us through on how to deal with some of those fears. So, Colin, if you're watching this, I'm looking forward to it. Those are a lot of good. There's a lot of fear out there that we face as real estate investors, and having your assistance on getting through those fears will be great. Okay, so one last shout out before we get into the net worth calculation. This week, I am starting an analysis group coaching session. And so this will literally like if you're having analysis paralysis, if you don't know where to start with your analysis, this is a good group to join. The fee, the investment to join is very minimum. Like think of all the knowledge you'll get. And after the 4 sessions, you will be comfortable analyzing. Okay, so if you're interested in getting more information about the analysis group, reach out to me on the QR code. Okay, that will put you in touch with my calendar and we'll be able to hop on to the analysis group coaching. Okay, so that is the shout out that I have for today. All right, so let's get into the net worth calculation. Yeah, the short-term rental and the long-term rental, we'll do that next week. That one is a longer calculation. The net worth one, I don't think will be that long. So let's jump right into it. All right. So give me 1 second here. Let me share my screen. All right. So I'm going to be bringing up a spreadsheet that you can use. And if you want this spreadsheet, it is available on our website for free. All right. So let's see here. So you should see the Excel sheet. Let me see where that went. Okay, so you'll see a file called Rich Dad Poor Dad balance sheet. And if you play the Rich Dad Poor Dad game, okay, the cash flow game, you'll recognize this spreadsheet. Okay, so I'm just going to reposition this so that you guys can see a lot of this. So this spreadsheet is available to like if you're playing that game, it's probably available online as well. So I've taken their template and converted it into an Excel sheet. Okay, because what I actually like to do with this is when I work with my clients, we actually address their net worth statement and we look at what incomes they have coming in on a monthly basis and what expenses they have going out, what their asset is. So this actually will give you a very good overview of your financial situation at the moment. Okay. So I like to run this with all of my clients going forth. And also when you're doing a portfolio review. So yeah, so if you need to do a portfolio review, this would be a good way to do it to make sure that you're not getting to the situation where you're going to be over leveraged. Okay, so I'm going to run through that. So let's go through this spreadsheet to give you an idea here. So usually what I would do is I would say, enter your date. So it's sort of a snapshot in your financial situation. So let's say here, so we're going to go September 16, 2024. Okay. So let's just say I have my engineering job and I'm making 150,000. Okay. So this is pre-tax dollars. Okay. Don't get all hung up on pre-tax, post-tax, or anything like that for now. It's really just to give you a snapshot in. You can always go back afterwards and be like, okay, I want everything to be post-tax dollars. Okay, then that's when you're going to go back and redo this a little bit. Okay, so I've got earned income of 150,000, and let's just say I have property one. Okay, so I'm gonna, you usually want the address of property one in here, and let's just say I get $2,500. Let's see here. So $2,500 a month. Okay, so now you'll notice that down here it's tabulating my income per month. So what I actually want to do is go back to my 150,000 and I'm just going to divide that by 12. Okay. So that means every single month from my employment, so whatever your employment happens to be, it's 12,500. Okay. And that's every month. So it doesn't matter if you get paid every 2 weeks or every month or whatever. It's just the 12,500. So my property one, let's just say it's one rental unit. I'm going to get 2,500. And then let's just say over here, I have another property and it's 3 units. Let's just say, so I'm going to go 3 units times, and let's just say each unit I'm getting $2,000. Okay. So that's per month. So that means I have $6,000 coming in every single month. Okay. So now let's just say for my RSP mortgages, okay, when you start doing private lending or something like that, you might have mortgages that you're going to fund. Okay. So let's just say for this example, we have zero. Mortgage pay down, we're going to leave that as zero for now, just so that you could see it. So, paper income is stocks. So let's just say you're getting some dividends. If you're doing day trading, okay, options, something like that, okay, you might have some paper income there. So at this point, we're just going to say it's zero. Okay. So now this is, see, and then business income. So if you are doing a side hustle other than real estate or stocks, if you happen to have business income, then this is where you would put it in. If you have any other private loans, any items like that. Okay, so now the total here is just doing the subtotal of the earned income and all of the rental properties. So at this point, I'm just keeping it very simple. I'm just saying, okay, you know what? I have my 9 to 5, and then I'm just starting out in real estate. So I've got some rental income coming from there. Okay, so now what's happening is that it's taking the 12,005 plus the 2,005 plus the 6,000, and that gives me my $21,000. Okay, so now this here should actually read all of those items adding up. Okay, So we're going to go back here and I'm just going to go equals subtotal. Okay. And I'm going to just put in a formula for the sum. And I'm basically just going to add up all of the mortgages that I have, or sorry, the rental income that I have. Oh, okay. So I don't want some, I want 9. Sorry there. Okay. So I just made a correction on the form here, or an update to it. Okay, so this is telling me I have 8,500 every single month of passive income. And so real estate is considered passive income, even though there's a little bit of work with it. Like even if you hire a property management company, you still have to vet the property management company. You still have to deal with your lawyers and accountants, and so there's still some active work in there. Okay, so now the passive income is just basically taking all of these cells in there, okay, and just adding it all up, okay? And it takes in your rental income, your mortgage pay down, and then all of your private loans or anything like that that you have going on. And that's supposed to be all passive. Okay, so here you go. You have a passive income of 8,500 in this example. Your total income is still 21,000. Okay, because it's adding up your 9 to 5 plus all your passive income. So that's fantastic. So you've got 21,000 just from your income and your 2 investment properties. That's fantastic. So now what we're going to do is we're going to put together your expenses for the month. So let's just say for food, okay, I'm just throwing random numbers out here. Okay, let's just say food is $1,000. Rent, if you happen to be paying rent, or you could be doing your own mortgage. Okay, so we're going to update that. Okay, so now this mortgage is going to be your primary mortgage, the one that you live in and that you have to carry on your own. That is not considered an investment property unless you're renting out portions of the house to somebody else. Okay, so let's just assume that it's that, and let's just say it's no, what's a good number? $5,000 a month. Okay. The car expense, so that would be for your gas, insurance, any maintenance that you would have to do, and then you would spread it over the year, so it'd be, per month roughly. Okay. So when you're playing this game cash flow, they'll give you a number, and I highly recommend that you take your Visa bills or your expenses for the course of a year and basically break it down into these categories and say, okay, you know what? During the course of the year, my car expense for insurance, gas maintenance, everything, new tires, winter tire storage, whatever, is this dollar amount. So I'm going to divide that by 12, and that's going to be roughly how much I'm going to be spending every single month on a car. So let's just say it's $500 a month. Taxes, this is property taxes. Okay, so this is how much you would have to pay for your property that you live in, property taxes per month. Okay, so let's just say it's $4,000, divide that by 12. So about $3,330. Now, this is your rental properties here. Okay, so we're going to say, so this is property 1 and property 2. Okay, so let's just say the expenses. So this is going to be all your expenses. And you might be like, well, Hung, I need more space to put all that in. Okay, absolutely. I actually have another spreadsheet that I break it down by property with every single expense item category. So that would be the mortgage, insurance, maintenance, property manager. What else would there be? Any sort of legals, accounting, so all those expenses, I tabulate each one. And then what I do is I actually compare it year to year to see if one of my expenses have shot up. Okay, which happens, like it can happen, especially like if you're in Toronto and you have to pay for the water usage. So you want to do that comparison at least every 3 months, because if you have your water leaking somewhere in your house and you don't catch it for a year, you could, any profit you make on your rental is out the window. Okay, so let's see here. So let's just say your rental property expenses. I'm just going to throw in a formula here, because usually it should be around, let's say 40%. Okay, so I'm just going to do a formula to calculate it based on this number here times 12. So let me see here. So I'm doing, oh yeah, so I don't need to times it by 12. Okay. So what I'm doing is I'm just saying whatever income I get, I'm going to spend about 40% of that on expenses. Okay. So like when I do my own numbers, I figure out what it actually is. I don't just assume it's going to be 40%. So I'm using 40% here. So it's about $1,000 that I would be paying out every single month for the first property one that I'm making 2,500 on. So I'm going to do that same estimation for the second property, which is my triplex. And I'm going to say, okay, it's going to be around 40% as well. Now, you could argue and say, Hung, you know what? That's insane. That's a lot of expenses. Okay, well, run your own numbers. If you have a brand new building, maybe it's around 25, maybe 30. But once you have an older building, like I've seen expenses up to 60% of your rental income. And it really depends on how old the building is. Okay, and whether or not you have to pay for the most of the utilities. Okay, so now we've got the properties in there for the expenses. So we're assuming no business expenses, no nothing else here. Okay, we're going to just keep it very simple. Child expenses. Yes. So if you have a child, you got to put this in here. So this would cover all of their extracurricular programs, clothing, any sort of other things like that. Okay. So in the cash flow game, I think it's like anywhere from $150 a month to $300, $500. So let's go in here and put $300 a month. Credit card expenses. This you would put down if you are carrying a balance and you have to pay interest every single month on your credit card. So this amount will definitely be different for every single person, and it depends on how many credit cards you have. Okay. And this could also be your HELOCs or any sort of other debt that you're carrying. Okay. It is always a good idea to pay off your credit card balance in full. Okay. Now, in full means not the minimum amount. Okay. I have to clarify that every single time I say that. Okay. So ideally, if you want to pay off your credit card balance in full because they're charging you anywhere north of 19%. If you are on one of those credit cards that are doing like a balance transfer or a delayed interest payment, like Canadian Tire is really good for deferring your payments for 2 years. Okay, then you don't need to rush off on that. Okay, so let's just say the credit card payment is $500 a month. Okay. And other expenses. So other expenses would be, I don't know, your property insurance, any sort of special fees that you're paying for, subscriptions, any sort of memberships, anything like that. Okay, so now let's see here. So we've got 11,033, and basically it's just taking the sum of everything that I've got in there. Okay. All right, so now my total expenses is $11,033.33. Okay, so let's see here. So now what you're going to see is you're going to see a note here. Okay, so your monthly cash flow is a positive number, which is fantastic. That means you actually have a cash flow of close to $10,000. Okay, the next number here is the additional passive income needed. So you still need another $2,500 to get out of the rat race. And the whole point of the cash flow game is to understand this balance sheet, to know what is passive income, what is an asset, what is a liability, and how much do you actually have to make to be considered out of the rat race. Okay. So you are out of the rat race if your passive income is greater than your expenses. Okay. So I want to just touch on this a little bit because your passive income is not your monthly income. It's not this 21,000. Okay. What I see with a lot of people who are learning this spreadsheet for the first time or learning this balance sheet for the first time is that they think that their passive income is just 21. It's not, because this 21,000 includes you going to a 9 to 5 making this 8,000 this 12,500. right? This 12,500 is not passive income because you physically have to be available 9 to 5 for your 9 to 5. Okay. So your passive income in this case is only 8,500. Okay. This is rental income. This includes your stocks. This would include any sort of equity income that you're making. Okay. That would be part of this passive income. Okay. If you put money into an investment, like a business investment with somebody else, and they're managing the whole business. So in my case, like I have a car wash that I invested money into, that is considered passive income. Okay. So to get out of the rat race, you want to be greater than this 8,500. Okay. So in this case here, my expenses is 11,000 a month. So that means that I'm not out of the rat race yet. Okay. So I still need to make another $2,500. Okay. So now while you're looking at this, you might be like, well, wait a minute, Hong, some of these expenses that you have here is from those rental properties that I have to pay out of pocket for. Yes, that is part of the understanding of getting out of the rat race. If you have to borrow money to buy these investment properties, okay, and you are in the negative, then you're in the negative cash flow scenario. So then you're technically not buying an asset. Okay. If you pull out cash from your HELOC or from a refinancing and you go and you take that money and you buy another investment property, the cost of carrying that property now comes onto this expense portion and increases your total expenses. Okay. So you have to take that in mind that yes, you can pull out the cash and be ahead. But if you take that money and buy a negative cash flowing property, that goes onto your balance sheet. Okay. So if you pull that cash out and you're carrying like another expense here. So let's just say we have a HELOC and we're able to tap into that HELOC and we have to pay another $300 a month to tap into, $500,000. If you take that money and we go now and we buy another investment property, so let's just say we go in and we put all that money into some stocks and we buy dividend stocks, and that dividend stock now gives us $600 a month in paper income. Well, now my passive income will actually go up. Okay. Because I've now got paper income coming in. So now my passive income now has gone up to 9,100. Okay. So now keep that number in mind. But now my expenses have gone up by $300 because I've taken on this HELOC money. Okay. So borrowing money and having to pay $300 for it to gain $600, I would say that that's a pretty good, it's a good decision to maybe proceed with that idea. Okay. Because now my monthly cash flow has gone up. My additional passive income that I need has gone down because I'm actually making an extra $300 a month. Okay. So now if my passive income has gone up, let's just say instead of 600, it's now $1,000. Okay. So it's 9,500 in my passive income. Okay. So my monthly cash flow has gone up. My passive income needed to get out of the rat race has gone down. Okay. So the additional passive income that I need to generate every single day now is just about $100, $91 to be exact. And the reason for this mindset thinking is, okay, what can I do to make an extra $91 in passive income every single day? When you break it down like that, well, it's only $91. It's not that big of a deal. But if you think, okay, I have to make $2,000 a month in passive income, then it can be a limiting, it can be harder to do. Okay. So if you're able to generate more passive income than what your expenses are, then you're out of the rat race. Okay. So for example, let's just say now we Okay, so the end of the year is coming up. So now would be the time that you send out your rental increases to all of your tenants to give them the right amount of duration time. So let's just say you're running this next January and the rental income now has gone up. Okay, so what we're going to do is we're just going to go in here and we're going to say times 1.02. So it's not a big increase. It's $50 a month. Okay, but at least it's gone up. Okay, and then we're going to go here times 1.02. Okay, so that's going to go up as well by $120, which is pretty good. So now my passive income's gone up. And let's just say I've been able to do some, like I'm getting really, really good at my stocks and I'm getting $2,000 a month in my stocks. Okay. So now I'm making passively, I'm making 10,600. Okay. Well, look at that. So now, just from making those changes, I'm very, very close to getting out of the rat race. I just literally need $37 a day. So, some idea on getting my passive income up that way. So, let's just say with your rentals, your one tenant moves out and you've got this new tenant moving in now, and you're able to give them the utilities. Okay. So now this property amount here is not 40%, but let's just say it's now 37% because they're able to, you're able to pass the utilities onto this new client. Okay. So let's see if that takes us anywhere close. Nope. We still need about $32. Okay. So you get the idea there, right? The more passive income you make, the minute that it's over your expenses, then you are considered out of the rat race. And this would be a good idea to be like, hey, you know what? If you don't want to work, this may be a good idea to be like, okay, you know what? I've got enough passive income coming in to cover all of my expenses. Maybe I just go part time. Maybe I can take a year off from work. Okay, so let's go to the next part of the sheet here. So the first part of the sheet that we focused on was the income statement portion. Okay, so now we're going to go and we're going to talk about the balance sheet portion. So this is a snapshot in time as to what your balance sheet would look like. So here you would put all your assets, all your liabilities, and you basically put it down here so that you can get a running total here. Okay. And you need this number to be able to figure out your net worth. Okay. So we have property one and we also have a property two. Okay. Okay. So here, this is the value that it is worth today, not what you paid for it. It's not what's outstanding in your mortgage, anything like that. Okay. This is how much the value is. So you can get an appraisal to know this, or you can, you know, get an idea from what other people are selling their property for around your area to know what the property's worth. So let's just say the first property is $1 million. Okay. And the second property, let's just say it's a little bit more because of it's a triplex fully rented. Okay. So not 17 million. That would be way too much. Okay. So in total, you have assets, okay, of 2,700,000. Now here we also have some shares. Okay. So we're okay. I'm going to leave that out right now and not include that in the net worth. Oh, sorry. I'm going to change that a little bit here. Okay. I'm going to go into, okay. I'm going to go back here. Let's remove that. Sorry. We're going to go back. Okay. So the real estate goes down here. So we're going to go property one and property two down here. Sorry. Okay. So no, sorry, I do need those things up there. Let's see here. So the cost. Okay, so I'm going to go back up here. Okay, so 1 million. Okay, and then we're going to go 17023. Okay, so that's the total of your assets. So now let's just say you also have a car and your car is 20,000. Okay, so in total, your total assets here is 2.7. Okay. Now your liabilities here is all of your debts that you're carrying here. Okay. So what we're going to do is, let's just say here we have your credit card debt. Okay. And let's just say you have $4,000 in credit card debt. So not too much. Your car, let's just say you still owe some money on this car. So it's 10,000. Okay. And okay, so we'll leave it at that. So your liabilities here is $14,000. Okay. Now we need to go and put in um your mortgages here. So here we're going to say, let's just say your first property is $1 million, and let's just say you owe, let's see, 650,000. Let's just say, and the second one, it's you owe 1.2 million. Okay. So your total liabilities here, okay, is going to be your 14,000 plus your total mortgages. Okay. So then your properties here. So we're not going to fill in your down payment and your cost issue. That's part of the cash flow game. Okay. So now to figure out your net worth is actually really, really simple. Okay. So I'm actually going to type that out at the bottom for you here. Okay. So net worth. Okay. So your net worth is basically all your assets minus all your liabilities. So it's going to be your 2.7 million in this case, minus your 14,000 that you owe in credit cards and anything else. And it's going to be the sum of all of these mortgages that you owe and any of the balance on your HELOCs. Okay. So that means that your net worth is $856,000. Now, the reason why this is an important number is, one, you can see it's not the 2.7 million that's your net worth. That is all the assets that you own, but it's not your net worth. Your net worth is this 8,500. If you were to sell everything, okay, so you decided like on the day of your passing, okay, if you have to sell everything and then pay off all your debts, which is your liability, so if you have to pay all that off, you would be left with around $800,000. Okay. Now, in this case, we're not talking about paying any legals, paying any agent fees or anything like that. We're just assuming that that's zero for now. Okay. If you had to pay everything off, you would be getting about 850,000. Okay. So now if you've got, let's say, TFSAs or RSPs, those would go into your asset line here. And hopefully you've got some money in your TFSA and RSP. So let's just say you've got, I don't know, 200,000. Okay. So the minute you put that into your asset line, your asset total goes up. So now you're almost close to 2.9 million, $3 million, which is great. Okay. So now your net worth now goes up by that amount. And now your net worth is just over $1 million. Okay. So this net worth is an important number because, one, if you want to be considered an accredited investor, you need to have this $1 million. Okay. You need to be over $1 million. So in this situation, if this is what your balance sheet looks like, you would have a net worth over $1 million. You would qualify as an accredited investor. Okay. If you want to do some creative investing, having this high net worth allows you to be able to participate in it. It allows you to be able to, get the information and for people to take you seriously. Okay. The other great thing about having this net worth now is that if you're going to go and finance a construction loan or a property or be a loan sponsor, okay, they will ask you for your net worth. They will want you to have at least 25 to 40% of assets from your net worth to cover the loan that you're trying to get. Okay. So if you do loan sponsorships, they will want to see that you have 25% of that loan value in your net worth. And if you do, then you're able to loan sponsor. Okay. So which is the great thing about that? Okay. So okay, so now the minute you refinance, let's just say your this property one, okay? You refinance this up to the 80%, okay? And you pull that out. Okay, so now your mortgage on it goes up to 800,000. Your net worth now has gone down because you've taken on a bigger loan. Okay. So now what you're going to want to do now, so the difference that we did there, what was the difference there? 100 yeah, about 150,000. So the minute you take out that 150,000, if you make another investment with that, well then now you're going to have a new asset, and you will have your mortgage payments will go up, right? So you do need to make those adjustments on this income and balance sheet statement. Okay. Now, okay. So I touched on the importance of having the net worth. Okay. So this is how you calculate net worth. Okay. So that takes us to the end of our calculation. Okay. I hope you found that fun because I love updating this. So I update my spreadsheet once a year, partly to know what my net worth is, because you know, your net worth should be going up every single year, and I love looking at my numbers going up every single year, and also too because I want to know what my assets are, what my liabilities are. I want to know if I'm still out of the rat race, okay? Because I don't want to have to go back to a 9 to 5. But if I have to, well then I have to, right? But at least this keeps my mind knowing, okay, you know what, Hung, I need $32.74 a day to stay out of the rat race. Okay. All right. So that is it. That's all I've got for today. Um, if you want to come to the mastermind session, that is this Friday, please connect with me over here and we will make that happen. Also, if you want to learn more about analyzing, okay, whether it's tools like this or analyzing properties, please do not let analysis paralysis stop you from making an acquisition here. There's like now is believe it or not, one of the best times to make sure you know how to analyze so that you can participate in some of these amazing deals that are coming up. Okay, because there's going to be a lot of real estate deals coming up. Yeah, that is going to be worthwhile knowing how to analyze and being able to have the cash to execute on them. All right, my friends, that is it for today. Thank you so very much for watching. See you next Monday.